Governor, you've been urging radical reform this morning. Looking internationally, what do you think the feasibility is of a global Tobin tax on financial transactions, particularly as it relates to achieving greater financial stability?
Well, I think of all the components of radical reform that we've discussed this morning, and that I've heard other people internationally discuss, I think a Tobin tax is probably bottom of the list. I don't think that in the central banking community the Tobin tax is thought to be the answer to the too big to fail problem. After all, it was proposed to deal with a quite different problem, which was excessive volatility in foreign exchange markets. I think there's much more support for the idea of thinking of the US-type levy as an ex-ante instrument on an indefinite basis. There are many different aspects of that to talk through, but I think that is the idea that will be much more likely to gain currency.
But if you look at the levy, the Tobin tax would raise a very, very significant sum of money. And those
I think it's important not to confuse the US-type levy with a Tobin tax. They're very different animals. And I mean, Sweden tried a Tobin-type tax, and all the transactions gravitated outside Sweden. I think the taxing transactions is something that's very prone to activity moving offshore, and it's not necessarily the scale of transactions that we think is the problem here. So I think if you're worried about excess volatility in financial markets, maybe it has a place. Though in practice, I don't think I know anyone in the international circuit who's enthusiastic about it. I think the levy is a much more serious proposal because it does go to the heart of the too big to fail issue. The American proposal is something which has been put in place in a backward-looking sense to recoup a certain amount of money to deal with a particular situation. I think the idea that's worth exploring in the future is the idea of countries collectively having a levy which would be on the balance sheet, excluding equity, excluding contingent capital, some reduction for longer-term debt. In other words, to reduce the incentive to use short-term debt, which is at the heart of the problems. That is an idea that's worth exploring. Now, it's not the only idea. There are maybe capital and leverage requirements will make it redundant if they're big enough, but I think you'll be looking at very big increases in capital requirements to do that. It may be changes in structure would make the problem redundant, so that actually once you've ring-fenced retail deposits, maybe a change in structure would mean that the statement that no one else would be bailed out would indeed be credible. I think there are many routes to get to the final outcome, but what I do think is common, and I was very struck when I read the evidence that Charles Goodhart and John Kay gave to this committee, that although they had different routes to get to the end point, they were basically getting to the same end point.
At the G20, it was given to the IMF to look into these matters.
Indeed.
What do you think is emerging? Is the sort of thinking that you're reflecting here what's emerging from the IMF process, and will that be the recommendation they will make?
The next G7 meeting is to be held somewhere near the North Pole in a couple of weeks' time, and no doubt, trying to keep warm, we'll keep warm by talking to each other about radical reform of the banking system.
Mr. Tucker, could I turn to you? You